Happy February, everyone. You know, this is the month of love, Valentine's Day. And we love packaging up insights that can help you better navigate the markets. So if you want more clarity on the situation, follow us on all of the platforms, Facebook, Instagram, LinkedIn, and YouTube. We also have a beautifully redesigned website with interactive features that can help you plan future goals, bold goals. It can also help you evaluate your risk tolerance. You'll get your own personalized risk number. Pretty cool, right? You can also find our latest insights and more, so check out the website, let us know what you think. We want you and your family to be successful, so we want our commentary and our tools to be on point and first class in every way possible. Okay, time now for February's 2-minute drill. Continuing our theme of love, the markets haven't shown much love to investors so far in 2022. No, we got out of the gate with a wild sell-off in the equities markets. All of the major averages were down. High multiple shares and small cap companies, well, they took it on the chin the most. Let's talk about why we think this is happening. And let's do so with an often cited quote from the great one. You know, I love quotes that are used so often they can become total yawners. But when they seem to fit the situation, then yes, let's go with it. So here we go, giving you a yawner that we believe sizes up what's happening right now in the markets. It comes from the great one, Wayne Gretzky, the famous hockey player who once made this comment about how to stay a step ahead of the action. He said, quote, "Skate to where the puck is going, not where it has been." Looking ahead. That describes perfectly the action we see in the markets, and not even just today's markets. Let's take the current situation. The prevailing narrative over the last year has been concerns over inflation, and that has since morphed into worries over Fed tightening, both rate hikes and balance sheet reduction. Both moves are intended to cool down the economy, and the trick here is to slow it down enough to stabilize prices without throwing us into a recession and creating high unemployment. No decisions have yet been cast in stone, but we believe investors are busy skating to where they think the interest rate puck is headed, hint, higher, and that's caused a repricing of many assets. If interest rates are headed higher, it means investors can find better income from less risky areas of the market. In turn, that puts pressure on the more volatile areas, including stocks. The way we see it, investors are basically shooting first and asking questions later. Yes, they'll expect aggressive tightening until they get a sign that tells them otherwise. So what are those signals investors should be watching? One could be the hard data. Analysts believe the Federal Reserve will raise the Fed funds rate next month. But investors will be looking to see if the initial move is 0.25%, a 25 basis point hike, or a 50 basis point one. We'll also need to watch the aforementioned inflation data. That's the primary reason the Fed feels forced to tighten anyway. Inflation really started picking up last spring, so inflation growth will be coming up against some tougher comparisons in the coming months. The direction of that data will likely influence the direction of the Fed. Lastly, watch the language of Fed officials, most notably the Fed chair, Jerome Powell. His words are always parsed so finely. If his language around tightening starts to soften, it could signal support for the markets. If. Yes, that's just it. Investors are always dealing with ifs. So I'll give you one more. If you're headed out to skate soon, remember the great one and his inadvertent lesson on the ways of Wall Street. Have a great month, everyone.